Hey there traders, David Floyd here with Aspen Trading Group. It's Thursday, April 26th, and I wanted to talk to you about two markets today. First of all, Meta, because it's in the news, big drop off in price overnight, off over $100, but something very interesting happened this morning on the open. Probably what a lot of people weren't thinking, and that ties in directly to the S&Ps as well, and I'll get to those second. But the whole idea behind Meta that I wanted to talk about today is the whole concept of market memory. And what do I mean by that? Market memory is simply the fact that each and every day there's buyers and sellers that conduct trades at various price levels, various frequencies, and over periods of time. In my opinion, it's our job as a trader to get a handle on where those price levels took place and map those on your charts, because that is where the actual edge as a trader comes in. It's not about having an opinion, although if the opinion maybe dovetails in with the price level, maybe you can add that to your equation. But by and large, price action and movements from prices take place where the market has left a footprint. That's why the market has memory. We all know where these trades took place. It's our job to plot them onto our charts to serve as a heads up as to where trades could take place. So case in point, Meta come out with bad earnings. I guess they're bad. That's what everybody said. I don't know. I'm not looking at this from a fundamental standpoint. But what we do know is that prices dropped over $100. Opened down around 418. Now 418 is a level that I have had automatically drawn on my chart for weeks in advance. This is not some level that just magically appeared today. That's been sitting there for a while, as has this 486 level, as has this 505 area. And as you can see, prices have a tendency to get sticky around these levels, thus resulting in trading opportunities. No different here. 418 was a huge level. Where did the market sell off to after the earnings report? Right to 418, where over a period of time, fairly long look back period, there had been a tremendous amount of buying and selling, creating basically a footprint at that particular price level. It's my job as a trader to but to calculate where those levels are by harnessing that data and plotting it directly on my chart, which is exactly what I did. Now everybody comes in today going, oh my God, Meta's this, Meta's that, it's all bearish. But what does Meta do instead? Hits that 418 level and starts to rally higher. Guarantee you there's a lot of people scratching their heads, and there's probably even a few people out there that were short, thinking at the bare minimum we're going to come down and fill this gap down here, down around 400, 405. Well, you're in a little bit of pain right now if you were shorting towards the lows. In addition to that, you also have the S&P 500 doing its own version of what Meta did. It opened lower and then moved even lower after the GDP data is what came out. But the S&Ps found a little bit of an inflection point. Same concept. 5042 was the level they found. Dipped below it, tried to get back above, couldn't, and then finally it did. And at that point, we'd been below that level without being able to hold. It's kind of like trying to push a beach ball under the water. It just pops right back up. But when the S&Ps go ripping up, it's going to drag Facebook along in tandem with it. So by combining two markets, one, the S&Ps, which is kind of the horse pulling the cart, and then Facebook, you had a situation whereby if you were long into the lows of Facebook today, you've had a great trade. It's what I call playing on the edges, playing when things get to here. Was it comfortable being a buyer down there? Nope. It's never comfortable going the opposite direction of what people are doing, but sometimes that's where the most robust trade setups are. Now, what do we do with Facebook now? Kind of hard. It's in open territory. The layup trade, and I hesitate to use the word layup because no trade is a layup, but the layup trade was being long down in here. Now, might the next trade be a short into this 486? Yeah, possibly if it gets up there, but that's getting way ahead of ourselves. The whole point of today's video is to simply note to you that leave the opinions aside, look for objective price levels in the market, and then determine how is the market interacting with those levels. Is it bullish or bearish? Because these levels are not bullish or bearish by themselves. They're simply a heads up as to an inflection point. Now, we could have just as easily blown through 418 and came back and retested it and held, and then I would have been bearish Facebook. But that's not what happened. So it's not a bearish, bullish indicator. Although you can go with the assumption support is support until proven otherwise, as is resistance. But again, it's a heads up. Most people weren't looking to go long Facebook today, but if you looked at the levels, you looked at what the S&Ps were doing, there was no other choice if you had to make one, but to go long Facebook. All right, that's all I got for you today, but market memory is incredibly important. If you factor that into your daily trading plan and leave the opinions and forecasts aside, because remember, market doesn't really care about your forecasts. The market goes where prices have taken place or where trades have taken place. It goes back and forth between historical reference points. It's our job to find out where those reference points are and then be there once they get traded. All right, David Floyd here with Aspen Trading Group. Please subscribe to our YouTube channel. Please tell your friends and colleagues about it. I'll be back with another video next time something really interesting pops up on my radar.